Okay, good afternoon and welcome back everyone to our first trade options education webinar series hosted by OptionsPlay. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. I apologize for the late start here, a couple of technical difficulties, but looks like we're all set here. Today we're going to be covering how to sell covered calls in your overall portfolio. This is a pretty essential strategy for anyone who's trading options in their portfolio. It's the strategy that you are approved for when you first apply for an options account. And our goal here is to help you understand this overall strategy, but more importantly, understand best practices and how to actually deploy this strategy for your overall portfolio. But before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. And keep in mind that options do involve risk. So please make sure that you understand the risks with regards to options trading before you embark on that for your portfolio. So today we're going to be covering the first half of the wheel strategy, which is a covered call. And in order to understand that, we're going to look at some examples to help you better understand what obligations you take on when you sell a covered call, when you should do it, and more importantly, what are some of the optimal cover calls that you should be looking for if you want to deploy the strategy you're going to learn here today in your own portfolio. And then lastly, we'll talk about once you're in a cover call, the different scenarios that you'll find yourself in and how to handle each one. And then the optimal cover call report that we have built here with First Trade that helps you automate what you've learned here today for your portfolio. So a lot to cover, but the primary thing that I want you to be able to walk away from today is a clear understanding as to how can I generate consistent additional yield on your portfolio today utilizing options. So like I said, the cover call is a essential component of what's called the wheel strategy. We'll cover the second half of the wheel strategy on our next session. But the wheel strategy is effectively a way to help investors get into an equity position and then sell that equity position, hopefully at a higher price, but doing so using options. Now, any of you that trade stocks or ETFs today, you're already familiar with buying a stock and trying to sell the stock at a later time, hopefully for a profit. But if you're an equity investor, the only capital gains that you have on that trade is the difference between the price that you buy and sell at, plus any dividends you capture while you hold on to that stock. Now, what we're trying to do here with options is to enhance that, meaning how can you buy a stock at a lower price and how can you generate additional income while you hold on to that stock as you wait for it to appreciate in value. So that's what we're going to cover here today is once you're purchased the stock and you're waiting for it to appreciate in capital, how can you generate some additional income, some premium, so that once you are signed on the cover call, you are basically selling the stock at a profit and then hopefully being able to reinvest that cash into a new stock that you want to purchase. So what we're focusing on here with the cover call here is the bottom half of this wheel strategy course. Once you own a specific stock or ETF in your portfolio, what can you do to generate additional income? Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. There's a chat window and a Q&A window. Please, you can bring up your chat window at the bottom of your screen. Okay, so let's take a look at the T-chart. Now, you have calls and puts, and you can either buy or sell calls and puts. And sometimes this can be overwhelming for, especially if you're brand new to options trading, as to which one you're trading, what the outlooks are. So today what we're going to focus on is the lower left quadrant of the T chart, which is a short call option. Now remember, the T chart, bottom of the T chart is bearish strategies, top of the T chart are bullish strategies. So when we refer to short calls, this is a bearish strategy that we're trading. However, keep in mind that that's not entirely true, because you're not just selling a call option, you also own the underlying stock. So that changes the outlook of the overall strategy. We're going to discuss that here in 1 minute. But the short call component of a cover call in itself is a neutral to bearish strategy. And remember, whenever you sell an option, you have the obligation to do something in exchange for premium that you collect. And in this particular case, you are taking on the obligation to sell. What are you taking on the obligation to sell? You're taking on the obligation to sell the stock that you own in your portfolio. And again, the goal is that you own stocks in your portfolio. You own those stocks in your portfolio because you believe that that equity will rise in value in the future, and you're hoping to be able to sell that equity in the future for a higher price, which is why you are taking on the obligation to sell that stock when you sell a covered call. It's something that you were going to do anyway. Why not collect some income while you wait for that stock to appreciate in value? And that's the underlying thesis of a covered call, is effectively you own at least 100 shares of an underlying stock or ETF, and it must be 100 shares or greater, because each option contract that you're obligating yourself to sell is for a minimum of 100 shares. You can't take on the obligation to sell 100 shares if you only own 50 shares. You must own at least 100 shares to sell that cover call, because the obligation for a single contract of a cover call is to sell 100 shares of the underlying stock. Now, the call option will pay you premium, meaning you are going to collect an income in order to sell that call option. And in exchange for that income, you're taking on the obligation to sell the stock at a specific price on a specific date. So those are the terms of the contract that you have to agree to before you get into the trade. So you have to agree to the specific price at which you want to sell it for, the date on which you must sell it for, or take on the obligation until, and then also the amount of income that you receive as a result of taking on that obligation. But the goal is that if you own a stock and you own that stock because you're hoping that one day you'll be able to sell it at a higher price sometime in the future, well, why don't we lock in that obligation today in exchange for some income today? That's the mentality here as you think about a cover call. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. I apologize, there's no chat. Understood. Um, so let's take a look at an example here. Let's say you own Apple stock, and let's say you own it for $130. You bought the stock at $130. You believe that the stock is going to rise in value to $140. And what you normally do as an equity investor is that you'd buy the stock at 130 and you could place a limit order to sell the stock at $140. So basically what you're doing once you own the stock is you take on the risk of $130 per share, because once you own a stock, the stock could potentially go all the way to zero and you would lose your investment if it does do that. That's a risk that you take. In this particular case, if your potential upside, or you believe the stock is going to rally to $140, that means your potential reward here is $10. So your exposure here is that you basically own the stock, you're exposed to the stock, and you can collect dividends on the stock until the stock reaches that $140, or until you choose to sell the stock at any specific price. So this, the equity component of it, I'm going to presume anyone viewing this today has a pretty strong understanding of the basics of buying and selling an underlying security and the dividends that you might collect as a result of owning those securities, the risk that you're taking on, and the potential upside that you have when you own a specific security. So what we're going to do is we're going to take the same example, and instead of selling a limit order on that Apple stock at a specific price, we're going to look at what happens if we were to sell a cover call on that stock. So here in this particular case, what I'm going to do is I'm going to sell a call option for the exact same strike price as the target price that I had on my stock. So basically before I was placing a limit order at the price at which I believe the stock was going to rally to. Now what I'm going to do is I want the obligation to sell the stock at the same price, $140. But in this particular example, when I look at the options chain, meaning when I look at what options are available for trading, and I go out to, let's say, in this particular case, the February expiration, and this could be any time frame that we're looking at. Let's say I go out 1 month or 2 months out, and I see that if I were to sell a $140 call option, that call option is currently trading for $3. What that means is that in order for me to take on the obligation to sell the stock for the next month or two, I'm going to receive, in this particular case, $3 per share in income. So for 100 shares, that's equivalent of $300 worth of potential of income. And what that immediately does is that once I sell the cover call, because I realize $3 in income, that immediately reduces my overall risk on the trade to $127 per share, and it increases my potential reward to $13 a share. And what I'm going to be able to do is I'm going to have the same exposure to the underlying stock, but in this particular example, every month that I hold on to the stock, I'm going to be able to generate roughly $3 worth of income. So if, let's say, the stock doesn't really go anywhere for the next few months, and I'm able to do this a few times, then I can generate $3 a month and continuously reduce my overall risk on my equity position, increase my potential reward on my equity position while I collect dividends. And let's say in the third month, the stock does rally to that $140 price. Now, once it does that, I'm obligated to sell the stock at that specific price. And at that point, perhaps I might have earned $8 to $9 worth of additional income for my trade. So not only do I make a $10 profit for the underlying security, I might also make $8 or $9 on income by that time. So I'm, in this particular scenario, nearly doubling my potential profit on that trade. Now, obviously not every trade works exactly that way, but this is just an example to help you understand what selling a covered call is like, what obligations are you taking on, and in exchange, what type of income you might receive as a result of that, and how that changes your risk reward. And the idea is that the longer you hold on to it, the more you're going to reduce your risk and improve your risk reward, so that if and when the stock does reach your ultimate target price and you sell your stock, you have more profits to show for it, and you've generated an income stream while you're waiting for that to happen. So in this particular example, I want to go through some real numbers to help you better understand this process for selling a cover call. Now, I'm using an example here of Seagate Technologies. They build the hard drives for computers, and it doesn't really matter the example here, but this was a stock that at one point had rallied fairly significantly from $70 to $100, pulled back to about 88, and maybe you believe that now is an entry point to look for a long exposure in this particular stock. And what I wanted to show you is the level of income that you can collect and walk you through a thought experiment to help you calibrate correctly how you should think about selling cover calls. Because I tend to find that a lot of traders who learn about the strategy for the first time, unfortunately, focus on the wrong elements. And by focusing on the wrong elements, you might have a par or suboptimal experience. And what happens is, you then say, hey, you know what? I thought I was going to generate a lot of income from this. I ended up, being completely different from what I expected to. I'm not going to do this anymore. So it's important that we kind of go through this thought experiment and make sure you calibrate the right framework and right mindset for selling covered calls. Okay, so let's say you own the stock at $88 and you believe it's going to appreciate in value. And you pull up the options chain and you see that you can obligate yourself to sell your stock at certain prices, and you're going to receive a certain amount of income for that. So what I have are three choices. Let's say you obligate yourself to sell the stock at $100, which is all the way up here. In exchange for selling your stock at $100, you're going to collect, in this particular case, 75 cents per share. That is a raw return of 0.85% because 75 cents of the $88 is about 85 basis points, less than 1% that you're going to collect on this obligation. If you annualize that yield out, it's about 7.4%. And this delta number, delta refers to the probability of the stock reaching the specific strike price by the expiration date. So in 45 days time, what are the chances that the stock will be above $100? In this particular case, it's about 15% chance. And if that happens, you're going to collect 75 cents. If it doesn't happen, and if it does happen, you sell your stock at $100. Okay. The second choice is slightly lower, 97.5. If you see the 97.5, well, 97.5 is probably closer to here. 100 is probably up here, just to kind of give you a visual. 100 is probably somewhere up here. 95 is down here, okay? So if you choose to obligate yourself to sell your stock at 97.5, you're going to collect, in this particular case, $1.05 per share. That's a little over 1% of the stock price that you're going to earn in about 45 days. If you annualize that out, that's about 10% yield. And this has a 25% chance that the stock will be above 97.5, and you will sell your stock at that specific price. And lastly, if you look at the options chain, if you want to obligate yourself to sell the stock at $95, you're going to be able to collect $1.50. That is a raw return of 1.69%. So you're earning a little about 1.7% of the stock's value in about 45 days in the form of income. Annualize that out, that's about 14.56%. Now, I know the chat window is disabled, but ask yourself, which one of these three would you choose? And you can pull up your Q&A window if you want. If you want to put your answer as to which strike price would you choose if you had to choose a strike price for selling cover calls. Would you choose the 100, the 97.5, or 95? Even if you don't type it out into the Q&A window, make a mental note to yourself. Which one would you choose to sell if you were selling cover calls? And a lot of times I find that the first-time viewer or first-time users of options trading, and specifically of this strategy, will typically gravitate towards this, simply because you have the highest yield, right? You're going to earn nearly a 15% annualized yield on this cover call, selling the $95 call option for $1.50. And that makes perfect sense, right? We're talking about an income generating strategy. Why would I not want to get as much income as possible? Especially if you think about it, this is a hardware company that pays a decent dividend of nearly 3%. Here, I can basically earn more than half of that, half of the yearly dividend in just 45 days. Why not? Right? That's a good amount of income that I can collect. That's substantially higher than what I would expect if I was just holding onto the stock. However, this is really where I want you to rethink and recalibrate your mind, because income, while important for the strategy, is actually a secondary benefit of the strategy. The primary benefit of the strategy is to help you realize capital appreciation when the stock makes what we call an outsized move to the outside, or perhaps an unexpected move to the upside. The goal here is to really help you capture the potential profits of the underlying security when that happens, because the risk that you're really taking here is the stock that you own. The risk with this strategy, with owning the stock, is that if the stock were to plummet back to 75, and it was to get back into the 60s, you're looking at hundreds of dollars of potential losses in your overall portfolio if that were to happen. So what you must make sure by when you take on this type of risk is that you are properly compensated for the risk that you're taking, so that if in case the stock makes a big move to the upside, you're also able to capture it, which is why after doing nearly 20 years of backtesting on this particular strategy across all S&P 500 stocks, testing out all different types of expiration dates and strike prices, we find that the optimal cover call is going out roughly 45 days to expiration and selling cover calls that have a relatively low probability of the stock being called away. About a 15 delta we find is kind of the optimal cover call. And when you look at an options chains will tell you the deltas. The probability is the best way for you to choose a strike price to sell on a cover call, because that's usually the most common question that we get from viewers is that, okay, I conceptually understand the strategy, but when it comes to picking a specific price, a specific date, I'm really quite lost as to how to do that. Well, this is why we do this research. We do the back testing over 20 years to give you a sense for what is the optimal expiration date and the optimal starting point, so that you have the ideal starting point for when you're selling cover calls. So you go out 45 days, you want to find a strike price that's closest to 15 deltas or 15% chance the stock will be above that specific price. And the reason for that is because from time to time, stock makes big moves, right? Big moves can happen to the downside. It can also happen to the upside. So if it happens to the downside, that's risk that you're taking. So what you must make sure is that if the stock makes a big move to the upside, you actually participate on that. We tend to find that customers who do this, who collect a $1.50, think about what you're doing when you collect a $1.50. You're basically saying, for an additional 75 cents in income, I'm willing to give up $5 in capital appreciation. So let's say the stock, maybe earnings, maybe something happens and the stock rallies significantly, right? You never know when it's going to happen. But when it does, what you've done is you've given away $5 in capital appreciation in exchange for 75 cents worth of income. Granted, you might be doing this for a few months before the stock rallies, but even if you go 3 months down the line before the stock rallies, you're still in that particular case giving up about $2.25. I'm sorry, you're earning in this particular case about $2.25 extra in income, but you've given up $5 in income of upside in order to do so. And that's never worth it for you in the long run, at least from our testing of this strategy over, hundreds of thousands, millions of trades. You always come out ahead if you choose the strategy that has a lower probability of hitting, a lower amount of income, will actually generate higher profits for you in the long run, because even though you're collecting less income from it, you're actually going to realize a much larger capital appreciation from the underlying security that you own, which is the primary reason that you own that stock. You own a stock because you think it's going to go higher. Make sure you give yourself room when you're choosing a cover call. So the optimal cover call is 45 days out using the 15 delta strike price, which as you can see, the annualized return may not be as sexy as the 15%, but when you really think about it, you own the stock, you're earning about a 3% yield. Here, you're earning 7.14%. You're still earning more than double the dividend yield in income here. So even though you're earning a less income, relative to the underlying security's dividend yield, you're typically still generating 2, 3, sometimes 4 times the dividend yield on a cover call than you do on the income itself from the underlying security. So if you take nothing else from today's session, this is the one thing that I want you to be able to walk away from, is knowing if you were to sell a cover call, how do you choose the strike price? Remember, income is secondary. The income part is a really nice to have, but the primary thing that you need to focus on when you're selling cover calls is capital appreciation. So make sure that you choose strike prices that are relatively far away from the current stock price, so that if the stock were to make a big move to the upside, if the stock were to make a big move to the upside, that you're able to actually participate in that underlying move. Okay, so now that we've kind of gone through a cover call, an example of a cover call, let's look at what happens after you sell a cover call, and what are the things that you can do. So first and foremost, even though this is kind of best case scenario, this is really where I see a lot of traders tend to panic. Because if you were to sell the cover call and the stock starts to rally, I tend to see a lot of traders say, I don't know what to do. This cover call that I sold, it's showing that I have a loss in that cover call. What should I do? This is really one where the best thing to do is to do nothing initially. Because any losses that you have on the cover call, you're gaining back on the underlying security, because you are hedged in your call, the short call that you have, with the 100 shares of stock that you own. So even if the stock were to rally to $500, right, your cover call, the call that you've sold, would be showing a very significant, a very, very large unrealized loss on that cover call. But to offset that unrealized loss in the call option, you would also have a very large unrealized gain from the underlying security itself. And it's always going to be hedged. So you're never going to take on a loss from the call that you've sold it yourself. You can take a loss on the security, right? If the security goes to zero, but you're never going to take a loss on the call option that you've sold. So in this particular example, the best thing to do is to do nothing. What you want to do is you want to simply hold on to the cover call you've sold into the last 1 to 2 weeks. Like as you approach expiration, that's when you want to do something at that point. Because a lot of traders who see an initial move in the underlying security, what they'll do is sometimes they'll roll their cover call or try to close out their cover call early. And what you're effectively doing here is you're locking in that loss on that cover call. You're not giving the stock the opportunity to rally perhaps up to that strike price, but maybe come back down a few days later, and being able to recover the losses on the short call option. So this is really where the best thing to do is to not panic and simply hold on to the cover calls you get closer to expiration. And just remember, getting your stock called away, generally speaking, you should be happy about that, because what that means is that you've realized a gain on the underlying security that you perhaps didn't even think was going to happen, right? Think about it. When you choose strike prices that have a 15 delta, that means there's only a 15% chance that's going to happen. That means the stock has rallied fairly significantly in order for the event to be triggered, for you to have the obligation to sell the stock. Now, in that particular scenario, that means the stock has rallied significantly. That means you may possibly at that point have realized a nice profit on the underlying stock that you've purchased. And, you've effectively made a profit on the equity investment. And now what you can do is you can take those profits and reinvest them into the next stock that you want to buy. So reframe your mindset when you think about cover calls, because psychologically we all want to buy the stock at the lowest possible price and sell the stock at the highest possible price, but that just isn't possible, right? So when the market gives you kind of an unexpected gain, the market makes a big move a certain month and you're able to realize some profits on your trades, don't think of that as a bad thing. You're taking some profits, and now you can take those profits and roll it into a new equity investment. So that's kind of how you want to handle the stock makes a big move to the upside. Now, if the stock were to trade sideways, this is kind of your best case scenario because, if you were to own the stock, you would have made no gain or loss. Maybe you collected some dividends, but largely you didn't have any gains or losses. So in this particular case, you basically are able to capture the income from the cover call so that you have some income to show for the underlying security that you own that you would have otherwise just been flat on and made zero money on, minus perhaps some dividends. So in this particular scenario, the rule of thumb here is that you want to hold your position. There's no harm in holding this to expiration, but for those of you that are a little bit more active, you can, once you collect 75% of the total premium of a cover call, you can roll that cover call early and basically sell a new cover call. Basically, again, go out 45 days, look for that 15 delta cover call, and that's going to allow you to access the income again. But the most important thing is to remember, after a call option expires, make sure you come back the following Monday to sell that new cover call. Sometimes, a cover call expires, you forget about it, and next thing you know, you basically don't have a cover call on and you're not collecting income. So to kind of continue that income stream, once your cover call expires, have a practice where Monday mornings you kind of look at your positions, see if any options expire the previous Friday, and if they have, build in some kind of discipline or into your schedule where you every single Monday you look at your portfolio and you look at establishing your new cover call positions for your portfolio. And lastly, if the stock were to decline, this is really where, remember, the biggest risk that you take with your underlying security is if the security declines in value. So you want to make sure that you handle these scenarios actively. So this is really where, if the stock were to decline, in this particular case, the cover call that you sold, let's say you sold it for 75 cents or $1, it's going to be worthless at this point, or very close to being worthless. The rule of thumb is that if you've collected it, or rather, if the premium on the option is less than 20% of what you originally sold it for. So for example, if let's say you sold a cover call and you collected $1 in income, if that cover call is now selling for 20 cents or less, meaning you've captured 80% of the potential income on a covered call, and you still have plenty of time left to go, don't let these go to expiration. Don't hold that cover call to expiration. Basically, lock in the gain on the cover call by buying back the call option, because if you sold something for $1 and you buy it back for 20 cents, you realize the 80-cent difference in terms of income or profits. What you can do is, once you realize those profits, you can sell a new cover call. Try to collect another $1 in income, right? The faster you're able to do this, the more you're going to have your income stream offset some of the losses from the underlying security. Now, just to be clear, cover calls are never going to be able to cover the full losses in the underlying security. They're always going to provide some income that's going to provide a little bit of downside protection against the underlying security, but it's not a hedge on your portfolio. So keep that in mind. But you have the opportunity to basically, if you are nimble, you can buy back that cover call for 20 cents on the dollar, sell a new cover call, try to collect another $1, and basically accelerate your income stream to help offset some of the losses that you now have in the underlying security. But this is really where sometimes you have to ask yourself some hard questions, right? You don't want to remain owning a stock just because you have a covered call. Some stock investments just don't work out. You have to have an exit strategy on the underlying security as well. So if you bought the stock at 88, now it's trading back at 60, maybe you should reconsider whether or not this is a stock that you want to continue owning. Because if, let's say, it declines to $60 and you say, okay, you know what? This is not working out. I'm going to buy another. I don't want to own the stock anymore. At that point, you got to sell your stock and you have to get out of your cover call. You must remove the cover call obligation before you sell your stock. Otherwise, you're still going to have the obligation to sell that stock at a specific price, even though you don't own the stock to deliver it. You're going to get yourself into some trouble if you do that. So make sure that if you do sell your stock, you also close out the obligation of the call option by buying back the call option. So that largely covers kind of the different scenarios that we have available, once you're selling your cover call. So what I wanted to show you is a report that you have available to you in your first trade account. You can find this under your research tab under options, and under the research tab, you will find 3 different types of opportunity reports. The middle one is the cover call report, which is what we're going to focus on here today. And what you can do is you can basically search for specific symbols on this report. So let's say you own Apple stock. What you can do is you can type in your symbol of whatever stock that you own. And what we will do is we will find the optimal cover call to sell. So let's say you own Snapchat in this particular case. So what this will do is it will pull the exact expiration date and the exact strike price that we just referred to in the session here. I talked about that the optimal cover expiration date is 45 days out. The optimal strike price is roughly about 15 deltas. This report automates that process for you. So even though I taught you kind of best practices, if you want to do it on your own, I don't expect most of you to necessarily have to pull up that options chain and do that work manually. It's a lot of work to do it. So we built these reports to automate this process for you. So you just have to know what symbols you own, at least 100 shares of, you type it in, we will do the work for you. We will find you the expiration date, we will find you the strike price, when we will tell you the amount of yield that you will collect. In this particular case, for Snapchat, you will generate 3.8% over the next 45 days. That annualizes out to 25%. At the time of publishing, Snapchat was trading at $9.40. The strike price that we're telling you to sell is $13.50, which gives you an upside of 43%, meaning the stock has to rally 43% in the next 45 days before you are obligated to sell your stock. So you can see these specific numbers that are important to you to help you understand the overall strategy. And it will also tell you whether or not there's earnings coming up between now and that expiration date. And it will tell you when the next earnings date is going to be. So you know exactly when that earnings announcement is coming out. That's a potential catalyst that could drive that stock up 43%. And just it's important that you know whether or not there's a catalyst event coming up. But these are the elements that you typically would need to make that trading decision. But the goal here is to give you everything that you need so that you can make a decision in just a few seconds. And if you do choose to do that, you can click on the trade button and send this order for execution on your first trade account. And you can basically just go down this list. Let's say you own some Tesla stock. You can type in Tesla. It will tell you exactly which strike and which expiration date, how much income you're collecting, and what is the upside in the underlying stock position if the stock were to rally to that stock position. So like I said, a 31% rally in 45 days is a huge amount. And I think that most investors that are owning a security you're not expecting a stock to rise 31% in 45 days. But if it were to happen, this strategy gives you an exit strategy to get out of your stock and actually realize that profit. Again, as human beings, we always in our minds think somehow we're able to buy stocks at the very bottom and sell stocks at the very top, but it's that fallacy that actually many times prevents us from actually being pulling the trigger when we really should. And what the cover call strategy does is it kind of locks you into a specific obligation where you say, hey, if the stock rallies 31% in the next 45 days, guess what? I'm okay taking profits and saying, great, I made a good amount of capital appreciation this month. Let me take that appreciation, let me buy a new stock with it, and hopefully next month, that new stock also rallies substantially. Now, and if you have a whole portfolio of different stocks that you own these cover calls on, eventually, some stocks make big moves in a certain month. And this strategy allows you to not only generate income on the portfolio that you own, but it also allows you to realize the capital appreciation if and when it happens. And that capital appreciation, many times, you might be surprised at how far it has to happen. How far higher the stock has to go in order for the stock to be, in order for the obligation to kick in, and you might be pleasantly surprised when it does kick in. That, hey, I've made a nice profit on this underlying security by selling cover calls, and even when it doesn't, I generate a nice amount of income to show for my overall portfolio as I wait for it to appreciate in value. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of cover calls, how to sell cover calls, and what are the optimal cover calls, and more importantly, how can you actually start implementing this immediately after we finish this session here today in your first trading account. So with that, what I'll do is I'll open this up for Q&A. There's a Q&A window at the bottom of your screen. If you click on that, you should be able to utilize that for your in your first. You should be able to ask your questions here in that Q&A window here at the bottom of your screen. Does the income opportunity report do the same thing in the options wizard? Yes, it does do that as well. Oh, sorry. Does the income opportunity report do the same thing that the option wizard does? Yes, it does. You can also do it in the options wizard as well. This report just gives you kind of a different way to look at it. But yeah, you can essentially do very much the same thing. There's a question saying, what is IV rank? IV rank tells you whether the implied volatility of the current option, where does it sit within the range that it's traded in within the last 1 year. So let's say a stock, had a low IV of, let's say, let's say a stock, when you look at the implied volatility of the option is ranged over the past year between, let's say, 10% and 30%. IV rank basically tells you where it currently sits within that current range. So if you have an IV rank of 100, that means the current IV is at the top end of its historical range. If you have an IV rank of 0, that means it's at the bottom end of the range. If it's 20, then it'll be at 50%. So it just gives you a very good sense for where does the current implied volatility for an option sit relative to its 1-year history. The higher the IV rank, the higher the closer it is to the top end of the range. The lower the IV rank, the closer it is to the bottom end of that range. And it gives you a good sense whether the premium that you're collecting, how much is that premium relative to its 1-year history. The higher the IV rank, the more relative income that you're collecting for that same security. May you buy a put while doing the cover call in the case of the security fallen? Yes, absolutely. The question is, can you buy a put option as you're selling a cover call? If you're approved for buying put options in your portfolio, maybe if you have level 2 options that'll allow you to buy calls and puts, then yes, you can buy puts. So I think the question was, if let's say you sold a cover call and the stock starts to decline, can you sell puts as well? And the short answer to your question is absolutely. You absolutely can. Can I sell cover calls on short stocks? No, you cannot. Cover calls obligate you to sell the stock. If you're already short the stock, you don't want to take on the obligation to have to sell more stock, and you want to take on the obligation to buy the stock. So maybe if you're short of a stock, you might want to sell a put option, but you certainly don't want to buy the stock. I'm sorry, you certainly don't want to sell a cover call. You can't sell a cover call. What is the delta concept you mentioned earlier? When you look at an options chain, when you look at all the available strike prices that you can choose from, the question is, how do you choose from it, right? And there is a Greek that's calculated on every single options contract called delta. Delta tells you the exposure that you have in the underlying option. So the delta, if an option has a delta of 0.5, that means for every $1 the stock moves, the option will move by half as much, so 50 cents. But delta also happens to approximate the probability of the stock being above a specific price on the expiration date. So what I was saying is that the best metric to choose the appropriate strike price when you're selling covered calls is delta, which is probability of success. And when you use probability based approach to select your strike prices, you're also going to have a much more consistent result. Meaning, if you always choose 15 delta cover calls, then you should expect about 15% of the cover calls that you sell will have the stock being called away, and the other 85% chance, other 85% of the time, you will basically collect the income. Yeah, I think that's the best way to think about delta. If my cover calls are in the money, should I let the stock fall away or roll to the next 45 days with 15 delta? Which one's a better choice? So Lee, that depends, right? And like I said, as humans, we all want to be able to sell the stock at the absolute high. And this idea of rolling your cover call to a new 45-day 15 delta call is basically saying, I think you can go higher. Let me move my cover calls to a higher strike price. And sometimes, that works out, and sometimes it doesn't, right? Sometimes the stock just starts to decline from there. And now, instead of realizing the profits, you've now given up the profits on the underlying security, and you have just a little bit of extra income to show for it. My philosophy is that when you're placing on a cover call, you should place it with the full intentions that you're okay if the stock gets called away. That's my philosophy for it. But sometimes new information comes out on the stock, and materially you genuinely believe that now, based on the new information, the stock has a lot more upside. If that's the case, you absolutely can roll your cover calls to that same 45-day 15 deltas, because now new information has come out. Before you were okay selling the stock at 140, but now new information comes out and you think the stock can go to 200. Well, obviously, if you think the stock's going to go to 200, you don't want to sell at 140. In that particular example, you might want to roll your cover call to a higher strike price and buy yourself another 45 days. Do you normally turn your cover call strategy to a collar strategy whenever you suspect it's going to a big sell-off in the underlying stock? Renee, that's a great question. I don't do it very often because there's not often that I own a stock that I believe there's going to be a big, sell-off. And if I truly believe there's going to be a big sell-off, I'd rather just sell the stock. I'd rather just get out of the stock and not hold on to that stock, because buying a put option is expensive. Buying a put option requires you to time the markets correctly. And the put option is not going to give you a full hedge. So for those reasons, even though conceptually it sounds great that you can protect yourself to the downside, many times it's much easier to just simply say, okay, if I really think there's going to be a big sell-off in the stock, well, I should just sell the stock. I shouldn't keep holding on to a stock that I think is going to decline in value significantly. I think your approach is particularly good for younger investors, but older investors, maybe a blue collar investor from Allen might be better. So, I believe, if I'm not mistaken, the blue collar investor, he sells a much higher delta. I think probably about a 30 to 40 delta, or even an at the money delta, at the money call option. Um, I don't know what your age has to do with capital appreciation, right? It doesn't matter what age you're at. You own the stock because you think it's going to appreciate in capital. Um, your appetite, the risk that you take, it doesn't matter how old you are. When you own Apple stock, you're taking on the risk of owning Apple stock, meaning you're taking on the risk that the stock declines. You must compensate yourself um, for the uh, the downside that you're taking for owning the stock. I get what you mean in terms of you're older, you would prioritize income over capital appreciation. That part makes sense to me. But from our back testing, by going more focusing on higher income cover calls, what you end up with is you just end up with underperformance. You sell your stock too early and you don't have enough income to offset the early sells. You're giving up $5 of upside in exchange for 75 cents worth of income. Um, I don't know, no matter what your risk tolerance is, why that ever makes sense, where you'd rather give up $5 of capital appreciation in exchange for, let's say, an extra 75 cents worth of income. That's just an equation that doesn't work out in the long run. And maybe you say to yourself, I'm not in it for the long run. I'm only going to be investing for the next 6 months and I'm going to be out. And if that's the case, I get it. But if you do think that you're going to be investing for at least a few more years, I would. Our research shows that you should be focusing on capital appreciation, not income. And I'm not saying that because I think you should focus on a capital appreciation. I'm saying that because you're just going to come out ahead in your portfolio by doing so, as opposed to underperforming if you focus on income. Hopefully that answered your question, John. Are investors ever exercising the strategy just to make the cover call income and buying stock for the express purpose of the cover call income? Great question. Bellevue is asking, does anyone ever sell a cover call? Does anyone buy a stock just to sell the cover call? That's what we call a buy right. And the short answer to your question is some people do, but I would not suggest that you do it. The risk that you take with the underlying security is too great to offset, any attractive yield that you have in the underlying security. So in this example of Snapchat, looks really attractive, right? 25% yield. But the reason it generates 25% yield is because the stock is a very volatile stock, right? So yes, it could potentially move 43% in the next 45 days, but it also means that the stock can decline 43% in the next 45 days, right? Like the volatility of the stock doesn't matter in terms of direction. So just because the volatile stock means that you could also lose a lot of money on this particular investment, right? So this strategy is for stocks that you already own in your portfolio. So you've done the research, you believe that there's upside in this particular stock, and now here's an opportunity to generate some additional yield on that stock. You should not buy the stock just for the cover call, in my opinion. Do you routinely buy back a cover call when the price is 20% or less of the original premium? Yes, Mark, that is the case. But like I said, when routinely, I think is not the right word, because if you find yourself routinely having your cover call, at 20%, that probably means that either the stock is trading sideways or these stocks are declining. And if you have a bunch of stocks that are declining in value, you should rethink whether or not you want to continue owning those stocks in the long run. I see a lot of investors holding on to bad investments because they don't want to take a loss. And what you don't realize is that the opportunity cost of dead capital is also that a lot of people just don't think about the opportunity cost of dead capital, right? Just because you don't want to take a loss, you're basically tying up money in a bad investment that could be reallocated to something better. So if I find myself, in a scenario where the stock is declining, you really have to reevaluate whether that's a good investment anymore. And you might want to just cut your losses and reallocate the cash that you could reallocate in that stock to something else that perhaps is better performing. What's the better strategy? Which stock to trade when using the cover call report? The cover call report is for stocks that you own, right? So think about, it's not about what's the best stocks to trade. It's what stocks do you own in your portfolio? You can only sell a cover call on stocks that you own in your portfolio. So think about, what stocks do I own? Those are the symbols that you plug into the cover call report. The trade columns already made prepared, either credit, spread, cover call, etc. What type of trade do you wish to do? I'm not sure I understand that question. If you don't mind clarifying, that would be helpful. Any timing consideration when selling cover calls? You can time cover calls, but I tend to find that if you try to time cover calls, one, you're never going to get it perfectly, and two, you're going to probably only sell cover calls 20 to 30% of the time, which means that you miss out on incomes the other 70 to 80% of the time. And it's just not worth missing out on that 70, 80% of income in hopes that you time it better, when in reality, you're not going to be able to time it better every time. So you're better off just always selling cover calls, not trying to time it, almost thinking of it like the concept of like dollar cost averaging. You just have to be constantly generating income because that constant income stream will provide, the benefits of it. Can you time it? Yes, but you will collect less income by trying to time it. And sometimes you'll get the timing wrong and you'll basically find yourself in a worse position. So don't time it, in my opinion. Is this the same as what a cover call ETF such as GEPI does? What I make much more doing myself. In theory, yes. But the cover call ETFs, they're typically systematic strategies, meaning they're not active. They just follow a kind of a dummy plan, if you will. For customers that say like, hey, you know what? This is just I get the benefits of it. I just don't want to do it myself. There are cover call ETFs that do this. They're obviously quite a bit more expensive. Um, they don't follow these best practices that I told you, going out 45 days selling the 10, 15 deltas. They usually sell about a 30 delta cover call. So if you look at the performance of those ETFs, they're not particularly strong performers. Especially if you compare it to the underlying security. Many of them actually underperform the underlying security. So you're actually better off just owning the stock and not even selling cover calls. So do your research. There are obviously a lot of different cover call ETFs. It really depends on whether you're doing a cover call ETF on a single stock or on the underlying basket of stocks. So do your research, understand kind of how much AUM are in those ETFs. A lot of them have very little AUM, which means that they're not particularly liquid. So those are all things that you should consider before you go ahead and buy a cover call ETF. But conceptually, yes, that's what those ETFs are trying to do, is to automate this process for you. So 45 days and 15 delta is just cover calls. What about other strategies? Each strategy is completely unique. So the 45 days, 15 delta is just for cover calls. What are your thoughts on net picks? I honestly, I'm not sure what net picks is, unfortunately. If it's a specific stock, I unfortunately have never heard of it. So sorry, I can't comment there. So with that covers all of the questions and what I have time for here today. That's a full hour. I just want to thank everyone for taking the time out here this afternoon. Remember, we are here every 2 weeks, Wednesday afternoons at 12 p.m. Eastern to kind of further your options education. Make sure that you have a well-rounded education to utilize option strategies for your portfolio, going over specific strategies, going over best practices, making sure that you understand how to deploy these strategies before you do them in your first trade account. And hopefully at the same time showing the tools that are available to you at First Trade that facilitate these strategies. And like I said, the cover call report that we have really automate all of the work for you so that you all you have to do is type in a symbol and you have all of the information that you need to potentially place a trade. It's one click on the trade button. You can pre-fill your order ticket and sell and start generating income in your portfolio immediately after you finish this call here today. So I hope many of you are able to explore that functionality. Again, it's under the options research. It's under the research tab. If you click on options, you'll be able to see the cover call report, and that will bring you to the screen that you see here. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here in 2 weeks' time on our next options education session. Thank you so much and have a great trading day.